Hey guys, it's Matt. We're going to talk about a really simple 20 simple moving average swing trading strategy today. Something I back tested and I teased in one of my last videos, and it's been way too long. So let's just jump right into it. Let's trade. Okay, first the entry criteria, and we're going to go over some of this on charts in just a minute. But first thing that must be true is that on the SPY, you must meet the following two criteria. The daily 50 SMA must be above the daily 100 SMA, and each of the 20, 50, and 100 SMA must be rising. Basically, we're checking to see if we're in a bull market here. That second one there about the 20 and the 50 and the 100 rising, you can play with that and do with you what you want. This is just how I back tested it because, you got to tell the computer exactly what to do, right? You can't tell the computer like eyeball it and see if you think you're in a bull market. So those are just the specific criteria. So if those are true on the SPY, then you can start looking for the stocks that we're actually going to trade, which is the second part. And you can see that the stock must meet the following criteria. It has to have a 14-day average true range greater than 75 cents. The 30-day average volume has to be greater than 6 million. And then the 52-week change has to be greater than or equal to 50%. And the way I calculated that was today's close minus the close of 252 trading days ago divided by the close of 252 trading days ago. So basically, the stock has to be up from where it was a year ago, at least 50%. And to initiate a trigger candle, you need the open of the day to be a greater than the 100 SMA. Uh, the days since the last high, or the high of the time period, has to be less than 120. So it can't be in a drawdown for more than 120 days. Let's put it that way. That's a better way to say that. The pullback from that high has to be between 0 and 15%. And then this is the kind of the bread and butter here is the high and the low of that day has to surround the 20 simple moving average daily, right? So basically, well, I'll show you in a second what we're looking for. I don't think I can explain it any better here. Uh, then once the trigger candle has formed, or you've found a trigger candle on a stock meeting all those criteria, the entry is the next day, okay? And you enter basically on a break of the trigger candle high or a lower high since the trigger candle. So it doesn't have to be the next day. It has to, like, you start looking for the entry the next day. If a few days go by and it doesn't break the high of that trigger candle, but it sets lower highs and it doesn't invalidate the setup, you can get in on like the second or third day after the trigger candle. Um, the stop is either the low of the entry day or the low of the trigger candle, whichever is a tighter stop. If at any time between the trigger candle and the entry there is a candle, these are all daily candles, by the way, with a high that is below the 20 SMA. In other words, the entire candle is below the 20 SMA. It invalidates the setup and everything's done. Then the cutoff for entry on the entry day is 9:45. So you only have to watch the first 15 minutes of the market. There's no price cutoff for any of this criteria. ATR is really the price filter. That probably could have gone on the previous candle or candle. Shit, that probably could have gone on the previous slide. It would have made more sense there, but here we are. Okay, once you've entered, basically you set your stop, which is 1R, right? Which again is the either the low of the trigger candle or the low of the entry day, whichever is a tighter stop. At the time that you're, obviously it's the low of the entry day at the time you're entering, right? Which is only the first 15 minutes of the day. So that's usually a tighter stop. Um, but you move the stop to break even after it hits 1R. So quick break even, you're protecting break even pretty quickly there. Um, and then if you've seen some of my other tests, this is similar to what I like to do as a trailing stop when I'm testing. But at 5R, you move the stop to 3.5R, and at 10R, you would move the stop to 7R. So it's basically 70% trailing stop there, sort of, right? So when you hit 5R, you move it to 70% of 5R, which is 3.5. Then again, once it hits 10, you move it to 7. You keep doing that. Um, and then, yeah, obviously, profit is the final step. We'll go over the results here in a little while. I just want to show really quickly the. I want to show this on some charts. Charts. Here's an example of a winning trade on Meta in December of last year, so December 2nd, 2024. By the way, guys, I tested this through March of 2025. It's now July. It just took me a while to get to the making the video on this. So we could trade the next few months, March through current and see what we get. But anyway, you can see. So this is the day prior. This is the trigger day, actually, I believe. And you can see the high here is 578.46, and then this is the start of the entry day. You can see this is a 5-minute chart. So this first 5-minute candle here is just a rocket ship. It opens, it dips, and then takes off, and then you can see the rest of the day there. Um, so basically, the entry happens at just a penny over the high of the previous day, which is 578.47, and then your stop is a penny below the low here, and the low is 575.57. So you can see 575.56 is the stop, the initial stop, right? So this 100% bar here, or line, I should say, that's your entry. This 0% is the stop. That's just the way this tool works in Thinkorswim. This is called the quadrant lines tool. It's just what I use to mark out my R ratios because Thinkorswim doesn't have a good way to do that. This one works well enough. So 100% here is your entry, 0% is your stop. The 200% line is 1R. I know it's a little confusing. And then each one of these is off by 1, right? So, in a sense, 450 is actually 3.5R. This 600 is actually 5R. So, basically, you enter here. Once the price hits this 1R target, you'd move your stop to break even. And then once the price goes up here to this 5R target, you move your stop to here, which is 70% of the distance between your entry to 5R, which is 3.5R. And then if the stop's not hit and price keeps going, this is 10R and this is 7R. Okay. Okay, so we zoomed out a few days here, or added a few days, because we didn't need as much detail than on this entry day. But you can see on the first day here, we hit that 5R profit target. We did not pull back to the now raised stop, which this is 3R. The second day, we run up here. I know it gets a little confusing with the lines, the way they're drawn. This is the 10R target, and this is the 7R stop. So once it hits this 10R target, we move our stop now from here, where it was at 3R, up to 7R. And then we get some sideways days, and then it doesn't come anywhere near the 7R stop. And then we get a run up here. This is 15R, right? And it's looking good here. At that point, when it hits 15R, we take our stop from 7R and we move it up to 10.5R. Again, that's 70% of the distance between our entry and the 15R target. And so then we spend a day up above that, and then you can see the next day it pulls back, and we get taken out right there at 10.5R, which isn't so bad. So that's the meta trade from early December 2024. Hopefully that helps explain a little bit about the trade management. And now let's take a look at the trigger and entry criteria. So we're just going to keep using this meta trade for a second here to show the trigger day criteria, and then the entry again just from a daily perspective. So I'm real zoomed out here on the daily chart. You can see we can see all the way back here to 2020, mid 2020, and so we're looking around here-ish for our entry. It was early December, so somewhere in this ballpark. But you can see that you're up quite a bit. Obviously, we had a great year in 2023, and so by end of 2024, stocks like Meta were still doing well, right? So it's not like we had a huge drawdown or anything from the peak of Meta. Remember, it's all about when was the most recent peak? Was it less than 120 days? And what's the draw? What's the pullback, right? So let's just zoom in on 2024 here. So we can see that we've got a high here in October, which is less than 120 days prior to our entry here on. It ended up being the 2nd of December, right? So let's zoom in on this area. So remember, what we're looking for a trigger candle is all of these things. And so we want to check that against what we're seeing here on the chart. So remember that the trigger candle is actually right here, and then the entry candle is here. So the close of this trigger candle is between 0 and 15% pullback from the high here on this day, right? So we made the most recent high. It's less than 120 days prior to our trigger candle. And the close of this trigger candle is between 0 and 15% pullback from this high. Okay. And it's surrounding the 20. The 20 is this red line here, this red dashed line. That's the 20 simple moving average. The white line is the 50. This is the 100. You can't really see it because I'm pretty zoomed in here. So as long as the open of this candle is above the 100, we're okay. And so then you see that this is the next day that we got the entry on. I took all of the drawings off for the R's and the stops and everything. So you can see that this is the little dip we saw in the morning, and then that was just a rocket candle, right? So what this strategy does is it catches days like this. It misses a bunch of days in between here. So if you look from here through these 2 months, you've got other entries that trigger and get stopped out, right? So it's a pretty low win rate strategy. We'll see that in a second when we check the data, but it catches days like this, and then you win 10.5 R. Okay, so this is all of the data that, all of the trades rather, that were a part of the data set. So you can see up here, I didn't mention this on the PowerPoint on the slides, but you can see we tested from 2016 to 2025. So you can see these were all of the trades. These are all of the individual trade items, right? What was the trade? What was the close? What was the initial stop? And then wins, losses, all of that stuff, right? We're gonna scroll over here, and all of these columns will look mostly the same from basically here on over. Okay, so what we see is that over this time period, we had 390 total trades. 72 were winners, 293 were losses, 25 were total scratch trades. It's a little hard to see. Let's widen that a little bit. Scratch trades just means break even, right? You moved your stop to break even and it got hit. Yeah, it's not a huge amount of trades over this time period, right? It's only 43 roughly trades a year, right? So not even one a week. But and you can see the win rate is just below 20%. Don't worry about this column. That was just I was testing something. The not loss rate is, rather than just taking wins and dividing by total trades, it's wins and scratch trades divided by total trades. So that depends how you want to calculate your win rate there, right? Do you want to calculate it based on actual just wins or any trade that didn't lose, right? So that's why this is the not loss rate. So it's a little higher. Total R for the entire process was 941. We'll get to what that means crunching, on what that means profit wise in dollar amounts. But this is just average win, average loss. This is win R, loss R. Most of your losses you can see are -1, right? Just quick little losses. Expectancy is 2.57. It's pretty good. This is the cumulative R. So you can see, you lose a couple here, and then you hit a big winner. So basically, what happens here is you get a loss, and this is the very beginning of the process. But a loss, a break even, a loss, and then you hit a 31 and a half R winner. So this is definitely a home run strategy, guys. You're going to strike out a lot, but you're going to hit giant home runs. I mean, you can just see this is just the first, whatever this is, 38 trades or so, right? And you can see four winners, but 31 and a half, 42 are, oh, sorry, there's another winner in here, five winners. And then the others are little base hits, 2.6, 3.5, 7. 2.6 happens probably when you get gapped down past your raised stop a little bit. Anyway, okay, this is the cumulative R, so this is just how many R we're up in over time. That helps us calculate some drawdown stuff. You can see the compounded annual growth rate is around 30%. Okay, let's look at this account balance column all by itself. So basically, I did this, crunched these numbers with, started with 25,000 as your account total, and we'll just skip to the end and see what this looks like. Again, this is after like 9 years, right? But you can see the number here is, it's a big one, right? It's about 18 million. It's not bad. Now that's if you, obviously, guys, look, that's if you never took any money out uh, and paid your taxes separately, not out of this fund, right? I mean, this is just you put in 25,000 and then you compound it for nine 9 years, right? Which isn't the most realistic thing in the world, but that's why we use R, right? You're still up 941 R's is, I mean, pretty good, I think. So you can just see this is like peak and drawdown stuff. The max drawdown was about 20%. That's a survivable drawdown for something that hits home runs the way it does. This account balance F column, let's look at this one too. This is if you don't compound. This is if you just started at 25,000 and you risk 1% per trade. Sorry, I forgot to mention that. So this column we looked at before, that was risking 1% per trade. Now this is if you had a $25,000 account, you risked 1%, which is $250, right? And then you just never adjusted that even when you were profiting. Um, so no compounding, just always risking $250 per trade. Uh, you can see you end up at like 260,000 over 9 years. Okay, one thing I wanted to go over is that there are some giant, like grand slam times a million trades in here, right? And so you can see this one is 192R, right? That's on the TQQQ, which technically meets the criteria. Now you could decide maybe you don't want to trade ETFs, right? And that's fine. That's the triple leveraged QQQ. Um, so yeah, that one's 192.5R. Okay, so what I did here, guys, was just filter for like the top biggest winners. So you can see you got massive R here. You've got this 154R trade on Nvidia. That's the beginning of 2024. The 192.5 on the TQQQ, and then 84R on UPRO. You can see 94.5 on SPY, which is funny because, right, that's SPY is one of the criteria. Anyway, you can just, you could decide to not trade the ETFs, right, which takes out a few home runs here. We're going to talk about that in a second, though. Then you can see there's a 63R trade on SQ and a 73.5R trade on Amazon. Um, those are all spread out. So every once in a while you hit a giant home run, right? So what I did was I recrunched the numbers, taking out the any of the trades that were above 100R, and recrunched all the profit and loss. So you can see the account balance column, that's the one that shows you how much money you'd make, right? again, starting with 25,000, risking 1% per trade, compounding. You can see we end up here at a little over 2 million. Right, so remember we were like 18 million before. So you definitely want to hit those home run trades, guys. Definitely makes a difference. Still, the total R was 594.5. So, you can do what you want with taking out the home runs, but this is a home run based system, right? So why wouldn't you let your like, I don't know, hit those goddamn home runs, right? I don't know. I don't know why you would want to take those out, but I do, just to crunch the numbers, just to be like, okay, but what happens if you miss one of those home run trades? What happens if you didn't log in that day and didn't take the entry, and it ends up being the trade of the year? How does this system hold up? So this is if obviously you've still got some big ones in here. I didn't take the ones that were like 73 and a half, like this guy right here. Still a pretty big trade. That trade on Amazon in 2018, right? Ends up being a giant winner. But you could take those out as well. You could say anything over 50, or what if we take those out? And you can crunch those numbers if you'd like. So one other thing that I did was I just tested, instead of a 5R initial profit target, I tested 10R, and we're just going to look at these really quickly. You can see total R was 850.6. This is with all the home runs left in. And then account balance, I mean, it's as silly as this is. Again, you're at 13 million, right? That's using 10R as your first profit. So instead of doing the 5R first profit target, you did 10R. This is 10R with no home runs. So in other words, anything over 100R, any single trade out over 100R taken out, just like it didn't happen. So you can see 591.6R. It's similar that it's a little, the expectancy is a little less, I think. I'm not going to look at the account balance. It doesn't really matter. Expectancy is 1.69. So yeah, I don't know. It's a little less than if we did the 5R profit target, because I think it just it takes some of those smaller base hits, and those add up over time, right? There's nothing wrong with base hits. So okay, guys. So we're just going to wrap it up there. Hopefully that was clear enough that you can understand that criteria and backtest it yourself. Obviously, you don't have to be such a hard ass about the criteria, right? Like if we're looking at the SPY and you're saying, in backtesting, I've got to tell the computer, hey, if the 20, the 50, and the 100 SMA are rising, we're gonna take trades, and if they're not, we're not, right? So you can see that. Let's do this. You can see here, like they're all rising right through here, and then there's this pullback. So here, while we're in this period, they wouldn't be rising, right? It wouldn't be until here where the 20 turns around again, starts to rise, that you would start looking for plays. But maybe you don't actually want to obey that. Maybe you just want the 50 and the 100 to be rising, right? Which continues to happen through all this entire period here, except maybe right here. It looks like the 50 is dipping down, right? But when I said, are they rising? It was basically like, is the value of the average today higher than the value of the average yesterday? I'm pretty sure that's how I coded it. Either it was that, or it was like 3 days ago, or something like that. But that's just for testing purposes, guys. There's almost always going to be some discretion with that, right? It's just a matter of how much do you want to zoom out. Right? If we zoom out here, we can look at I mean, it's even hard to see, but like, zooming out, you're like, oh, the 20 is almost always rising, right? Like it's hard through these pullbacks to make an argument for rising there, but like, I don't know, from left to right, it seems to go up, right, until this giant pullback here. Um, but yeah, anyway, that's just, you can, when you're actually implementing a system like this, you can throw in your own discretion if you think that will be helpful. Just when we're back testing it, If you're backtesting with just data and code, you have to just tell it what to do, right? And it's going to be a hard ass about it. It's not going to ever fudge the numbers, or it's never going to go, well, this is just kind of a little pullback. Because the truth is, when this moving average starts to turn here, you don't know that this is going to be just a little pullback, right? This little dip that then takes off and makes newer highs. You don't know that. It could be this, right? Because when it starts to turn here, you could be thinking too, oh, this is just a little pullback like the one back here. And then, yeah, maybe that's true because it does make a little newer high right here. And then you get smoked, right? So if you start to ignore the moving average being in a downtrend, right? Then you get bitten, and you're taking trades all the way through here, right? All the way through here, and then you're just getting smoked because you're not gonna be finding winners through there most likely. It's just the market environment is not right for you here, right? So that's what that's what this part, the spy, and then even some of this does. We're trying to really that's what this part of the setup does, right? It's just a simple way to say, is the market environment right for us for this strategy right now? And if these things aren't true, then we're just saying no, it's not. So again, you can do what you want with this strategy, guys, or something like it. I mostly do this because I want to show you how I think about going about testing these things, and then hopefully you can take some ideas from this and do what you want with it. All right, guys, we're going to wrap it up there. Hit the like button, throw me a comment, tell me I'm an idiot, all that stuff, and we'll catch you in the next one. It's trade. And that was dog shit. All right, guys, we're going to wrap it up there, and leave me some comments if I screwed something up, or if you have a question or leave a comment if you have a comment. Fucking